Okay. Thank you. Good morning, everybody. This morning's panel is a tough act to follow, but we'll do our best. I think our panel is the logical next discussion about financing. I think we had a chance to hear from the porridge developers. Now we have before you a number of different financiers. Essentially, we will be discussing the role of various financing vehicles, how the role they play in infrastructure project development. We'll spend some time talking about the newer kind of vehicles like SPACs, DFI project development vehicles like Africa 50, IFC Infra Ventures, I hope. And we'll try to discuss how we can match funding across all phases of the project life cycle and spend some time on exits. So I will ask my panelists to take some time to introduce themselves before we get into the substance of the debate. I'll start from my extreme left with Alex. Thanks.
Hi. Wow. My name's Alex Caton. I'm with Infraco Africa. I'm not sure if this is my 5-minute slot or just to give my name, but I'll say a bit more anyway. So Infraco Africa, as mentioned briefly by Electra earlier on, is an infrastructure project finance vehicle. Provides both capital and expertise to develop very early stage infrastructure projects. So our starting point is getting a site, starting to measure wind in the case of a wind project. In the case of a hydro project, it's hydro studies. So we take very, very early development risk on projects. Some of the speakers on the first panel today from the private equity business using a lot of terms about risk capital, about exit multiples, cash multiples. And I guess that's the business we're in. It really is risk capital. It's very early stage. It's binary. Either the project happens and you get your money back, maybe a bit on top, or it doesn't happen and you lose all your money. So in terms of, is it a successful, profitable business, developing early stage infrastructure projects, our geographical mandate, if you like, is the mid 40 countries in Africa. So Infraco will only go between north and south. Our mandate is defined by, is it a post-conflict fragile state? Is it DAC 1 or DAC 2? DAC 1 or DAC 2 means what's the average, is based on the average level of per capita income in the country. So we're focused on the tough markets. Our money comes, so my company is capitalized. We have equity investment from 4 European governments into our little limited company in the UK. And we work with a series of developer teams, Electra being our principal developer team. We also work and have a contract with Aldwych, and Helen Tunno was on the panel earlier today. And then we work with a third group of developers, what we call co-developments, which is one group of developers who have a project. They come to us and say, will you back us at this early stage to try and get this project to financial close? What kind of deal can we come to together? And there's some guys from our Western Power Project, which is in Western Province of Zambia. So APP are one of our other developer teams who are here in the room today, developing. In that case, it's a kind of 50 megawatt, roughly, run-a-river hydro project, early stage in Zambia. I've nearly got to my 5 minutes, so the other thing to say was just last year we signed 5 new deals in kind of mid-Africa, which in our business is a real success. In the context, the previous 3 years we'd signed 2. So 5 new deals, all in renewable energy, 2 hydro, 2 solar, and 1 geothermal. And when I say signed a new deal, it means we signed a binding development agreement to commit capital to the development phase of that project to get it to close. So total capital commitment in those 5 projects for us is about $36 million. So we're committing, whatever that comes to on average, roughly slightly about $7 million per project. And we normally spend on average, I guess, between $5 and $10 million getting a project to financial close. Some of the heavy legal costs we heard earlier in that Nigerian project, $20 million for legal costs. We hope not to see that in our projects. But we do spend an average of about 10, and the average project development time, we talked about patient or committed capital. So our average time in developing a project I'll try not to look at Tom as I say this, but it is about 5.5 years on average on the 8 projects we've closed, or we've got to financial close to date. We've been running, as Ebbe mentioned, around about just over 12 years now. So most of those projects developed and closed by Electra, in fact, all of them. So 8 projects closed by them, and we're now working with Aldwych on a project in Chad, which is one of our new solar projects, a 40 megawatt PV project in Chad. And then we're also working with companies like Berkeley Energy and their geothermal project in Ethiopia, and a series of other hydro projects, and a small renewable energy PV rental business, which I'll talk about a bit later. If we come to alternative financing structures and SPACs, we're kind of trying to link that containerized PV rental business into a different kind of financing for development finance, which is investing in companies that are developing projects, trying to get away from this traditional and very time-consuming, expensive project finance model. Thank you.
Thanks, Alex, for that very detailed introduction. Elliot, you want to say something about DBSA?
Is it still morning? Yeah. This morning, Elliot from the DBSA. The DBSA stands for Development Bank of Southern Africa. Of course, we are a debt financier for infrastructure projects on the continent in the sectors of energy, transport, ICT, and bulk water. But as we all know, and I think it has been discussed in the first session, as well as by my colleague here, the biggest problem is, of course, in the development phase. Now, the DBSA being an entity established in terms of the DBSA Act, not a private company, we take our so-called profits and we use that money every year to finance project development. Now, the important thing here is the DBSA finances project developers. We are not a project developer, but we provide money for project developers. Now, this in some cases, of course, enables us to take much more risk than the project developers take themselves. Now, in light of this, there is 4 funds that the DBSA manages, which are accessible to everybody. The first one is there is an EU-sponsored fund called Infrastructure Investment Program for South Africa. It's there on our website on the very first front page. You'll find it. That is 100 million euros provided by the EU that is under management by DBSA, money to be used solely for project development in South Africa and in some cases in SADC countries only. And that is available until 2020. If you are a project developer and you don't come and fetch it, you lose, you snooze. Simple as that. We also have $10 million sitting that is provided by SADC, the SADC Secretariat. It's managed at the DBSA solely for infrastructure projects in the SADC region. Now, that as well is also on our front page. If you just go to www.dbsa.org, you find it right there. It's not hidden anywhere else. Therefore, you can also contact us. That money is available. It is grant financing, non-recourse, non-repayable, mahala. If you have a social grant in South Africa, if you know what that means, that's what it is. You get it, and you don't even look back. It's available purely for that. And as I highlighted earlier, DBSA itself also provides plus minus 200 million purely for infrastructure project preparation on the continent every single year. Now, lastly, I'll just highlight 4 things that I think why we are also best positioned to be involved in project development. Firstly, is that developers like us because we take risk with them, and in some cases more risk than they do. Okay. Consultants like us because with the funds that we manage, if a developer comes and applies for funding and we approve money for them, we don't take money and put it in the bank account of a developer. We pay money directly to the consultant for a work that has been done. Therefore, a typical project that would have been, say, an RFP issued by a municipality where people say that municipality takes long to pay, they have their finances are not in order, etc. All that is gone because you get paid directly by us at your nice full rates instead of your government-based lower rates that you normally earn. And then I would say the next thing is government entities such as your, say, Transnet or Transnet equivalent in many other countries. They like us because we are also government owned. In essence, it's very easy for them to trust us. And we also have the political mileage that when a project is stuck for any other reasons, we have the leverage to call a minister instead of a project developer that will be going to the newspapers and making all the noises. We can easily ask for a meeting with the minister and say, we provided money for that project, can we fix whatever that is missing? Therefore, we provide that kind of security and that kind of support for developers. Lastly, most developers, some of them, they're just given a license or so by their respective governments to develop projects. We also have a team of specialists in all the 4 sectors that are highlighted earlier, including environmental specialists, social and institutional specialists. We have financial modelers in-house, and their job every single day is to review the work that's done by consultants on every invoice that we go in to pay. And the primary goal is we review that, you help them to structure it in such a manner that when all studies are done, there is no issues whether a bank can finance that type of transaction, whether that type of transaction or not. So our scorecard is value of bankable projects and nothing else. Thanks.
Okay, another detailed introduction. George, I think you'll take 1 minute.
Yeah, I'm not sure how relevant commercial banks are anymore in this space, but let me try at least for a minute. So my name is George Kotsovas. I work for Standard Bank. We focus primarily on raising finance for project financing across Africa. Most certainly our footprint helps us originate the right deals for ourselves and helps clients find the right deals as well. So we work very closely with developers who have got the right track record to approach them and say, well, you know, here's a deal that we should be working together with you on. So given that we're a commercial bank, we're not going to take undue risk in providing development capital to developers, unfortunately. I mean, there's other people who are well positioned to do that. But we most certainly will work very closely with developers to help them structure the right deals. And for us, track record is key in working with developers. So there needs to be obviously a certain amount of capital that they have access to. And we do give preference to developers who've got the right track record. And in those instances, we can provide the same support that comes from DFIs in this space. Thanks, Angela.
Last but not by no means least, Prejelin from the Johannesburg Stock Exchange.
Thank you, Angela. So hi, my name is Prejelin Nagan from the JSE. I head up the primary markets division at the JSE, which is a unit responsible for business origination across equity and debt listings at the JSE. You know, also responsible for trying to develop new products for primary issuances of equities and debt. Just very briefly on the JSE, for those of you that don't know, you know, the JSE is ranked globally as the second best exchange in the world. That's according to the World Federation of Exchanges, so a real accolade for the JSE. The JSE gets #1 rankings across fields such as the ability to raise financing via the equity markets, #1 for its incorporation of certain reporting and auditing standards into our listing requirements. So, you know, an exchange that we in South Africa and I think on the continent are proud of. You know, we've got 2 boards on the JSE for equity raisings, the Altex board and the main board, focused on different companies at, you know, at different stages of their growth profiles. Yeah, I think that covers off the JSE.
Thank you, all of you. So now we go into the substance of the discussion. We start off with Prejelin. Capital markets are cited as underutilized resource of capital. What innovative ways are you trying to get your investors invested in African infrastructure? And secondly, what should developers do to access some of that capital?
So I think, Angela, it's obviously safe to say that capital markets are being underutilized at present. My response, I guess, will look at two things. One is a new initiative that we're undertaking at the JSE together with National Treasury and in conjunction with the World Bank, which is the creation of a listed project bonds framework. And the second piece of my response, I think, will relate to special purpose acquisition companies. Alex mentioned that term earlier. It's a SPAC. So I'll talk a bit about that. So from a listed project bonds perspective, that is a key initiative for us at the JSE. I'll just give you some context around what that is. So at the moment, most infrastructure finance is done via project finance, via banks. And it's warehoused either on bank balance sheet, George, I know you'll talk about that a bit, or directly on the balance sheets of state-owned enterprises or municipalities. But you've got an instance now where you've got these infrastructure needs and capital sources which aren't able to meet those infrastructure needs. That coupled with certain bank regulations and Basel III in particular, I think might increase the cost of funding from the bank. So we have to try and look at closing that funding gap in a more sensible way. From an investor perspective, I think what we've got here is a situation where you've got about 8 trillion rands worth of assets available from non-bank institutions in South Africa versus around 4.8 of bank assets, so a massive pool of non-bank assets available for deployment. So, trying to look at matching that asset availability to liabilities in the case of infrastructure bonds. Other regulations such as Reg 28 of the Pensions Fund Act and other certain types of regulations require institutional investors to invest in listed securities. So you can follow the line of thinking here. We've got a funding gap, we've got a pool of assets, and we've got assets that required to be listed. So this listed project bonds framework, we believe, could achieve matching of those assets in a listed and tradable security on the JSE. There is certainly precedent for listed project bonds globally. We've seen these in the US, Europe, from an emerging markets perspective, Malaysia, Chile, and locally in Nigeria and Kenya. So, there certainly is precedent for the listed project bonds initiative globally. So something that we are certainly very excited about and working towards together with the stakeholders that I've mentioned, as well as some other relevant stakeholders in the industry. The second piece that I mentioned related to SPACs, and what that is really is a listed shell company. You've got two, from a South African perspective, you've got a SPAC which can raise up to a minimum of 50 million rand, that's on the Altex, or 500 million rand, that's on the main board. With a SPAC, you're really taking a view on the jockey, so you're taking a view on management, being able to go out there and find assets which they can merge with or buy into the SPAC that would qualify for a listing under the JSE listing requirements. So really a format of raising capital for M&A type of transactions down the line. To put things in context, we've had 6 SPACs listed on the JSE, 3 of which are involved in the infrastructure or energy space, those being Gaia, Renogen, and most recently Hulisani. The combined capital raised by those 3 SPACs is 1.1 billion rand. So, certainly a real example of capital being raised for infrastructure and energy in South Africa. Some of the benefits, or actually some of the mechanics. So once you've listed your SPAC and you've raised the capital, management is required within 24 months in South Africa to go out and acquire an asset that would qualify for listing under the JSE listings requirements. Some of the investors, some of the benefits of a SPAC for management, you've got a clean public shell, so no historic issues coming in. You've got the creation of valuable acquisition currency, an attractive environment for risk-tolerant investors to promote the formation of capital. From an investor perspective, you've got a regulated environment on an exchange. You've got the comfort that 75% of investors are required to improve any change in the acquisition criteria of that SPAC. So when you list a SPAC, you sort of say, I'm going to look at this industry, energy or infrastructure, services, fintech. Those are just an example of some of the SPACs that have listed. And a SPAC is not permitted to obtain additional debt financing unless the funding is utilized to facilitate acquisition of assets. So I think to close, I think those are probably my 5 minutes, but what I'm hoping has come across here is that, you know, we have got some innovative thinking around how to go out and raise some additional capital for infrastructure financing, some ideas which are currently in play and hopefully working towards that aim. But certainly, you know, this is an area where any new idea, any new potential source of funding is something that we should all be looking at, and certainly as the JSE, we'd like to think of ourselves as being innovative and trying to facilitate business. So, you know, we would certainly look towards coming up with new ideas as the infrastructure development of our continent rolls out. Thank you.
Thanks. Alex, let me go over to you. The other form of vehicles are SPVs. They are growing in significance as a resource for developers to access capital. Could you tell us about Infraco? What more SPVs can do to facilitate finance for developers on the continent? And also, could you please tell us about all the latest ways that you're trying to innovate to access more capital in some of your projects?
Okay, thanks. So SPVs, or special purpose vehicles, most the people in the room I'm sure will be familiar with the idea of setting up an individual company which has a specific objective, hence special purpose vehicle. In project finance transactions, that's very standard as the asset owning company that would then be set up as a non-recourse vehicle. So project sponsors can raise bank debt and can raise finance on a balance sheet related to that project only, without effectively increasing the gearing on its parent company or its investors' balance sheets. And we see these in most of our projects that are incorporated in different places, and we have a limited number of jurisdictions where we can incorporate these special purpose vehicles because of the particularly more focus with recent tax haven scandals in the UK. But Mauritius is the most common place for our projects to be incorporated. PV. We're starting to look at projects that aren't incorporated as SPVs, that aren't standalone project vehicles. And I mentioned one which is a containerized PV rental business, which is incorporated in Tanzania as a trading company in Tanzania, as a limited company. And the difference here is that we're starting with a much smaller project. Here we may be investing $5 million in a project to get that business up and running. Now, in that case, there was some seed capital came in from the Shell Foundation. So Shell had gone in to back the research and development part of this project, which was to develop a containerized PV solution. So with a control system, all the PV panels were packed into the container, and they had a patent for a special hinge that allows this containerized power project to be deployed in 5 days. So 5 days from getting the container to the site, having all your panels pegged out and plugged into the control system. So as long as your customer has a wire that can plug into your container, you have an operating power plant literally in 5 days. We didn't really believe this because, as I said, our average deal time is about 5.5 years to get something even to financial close. So we put some money into this project back in December 2015, and the first 2 containerized PV solutions, mini power plants, are running in Tanzania now within 3 months. And from getting to site, it really was 5 days to get them up and running. So this is an example, if you like, of a much quicker form of financing. And it is in some ways similar to a special purpose acquisition company in that we made capital available, and with Shell Foundation and other European investors raised some money through a series of special purpose vehicles and backed a management team who had experience, which is the similarity, I think, with SPACs. In the context of a traditional SPAC, it really is to acquire an operating vehicle. In this case, with our project in Tanzania, we are backing a management team through a corporate vehicle. And we're looking in Tanzania at another similar project finance alternative transaction, which is a way to develop mini hydro projects. So again, mini hydro projects, traditionally, people talked about if it's not $50 or $100 million, don't bother trying to project finance it. And we've got, and again, Electra, Ebe in the corner, we've got scars to show how difficult it is to project finance a $50 million project, which we did in Uganda on Lake Victoria. We set up an island utility with 4 different components to it. So ferries, a mini grid and power generation, PV, solar diesel hybrid power plant, and a water purification distribution system, all neatly packaged, contracts negotiated, the lawyers had a field day. It took about 8 years to negotiate all those agreements and start the project. And Nedbank, by the way, if there's any South African banks, as well as Standard Bank, but the South African banks, Nedbank in that case, came in, and we managed to project finance it in the end. But the lesson learned from that is, if it's small, try and do it on balance sheet with either just your own balance sheet or a couple of partners to get these things up and running quicker. And in the case of the mini hydros we're looking at, we'll do one plant on balance sheet, so raising $15 to $20 million is not impossible from either 1 or 2 institutions or institutional investors. And then you can start to leverage as you move on to number 2 and number 3. So building a mini portfolio of mini hydros is how we think you can get mini hydro operating on the grid. And we're looking at that in Zambia, and we're looking at that in Tanzania. So there's a couple of examples, if you like, of alternative structures. And don't get me wrong, I think project finance is still going to be the way on the bigger projects. It's still going to have a huge role. But there are alternatives, like the way the mobile phones businesses started up 15 years ago in Africa. They started small and grew rapidly through technology. And some of the off-grid, which is what Rodavia, our investment in Tanzania is, these off-grid projects can grow very rapidly. You're already starting to see secondary investors coming into a similar business in Kenya and suddenly investing $40 million to grow expansion capital in the off-grid space. So we think we do need different financing structures, and we're starting to put some InfraCo balance sheet and our shareholders' money into those structures.
Thanks, Alex. Let me turn to Elliot. DFIs have been at the forefront of developing financing infrastructure projects in Africa. What are the various roles that DBSA and other DFI peers play to bring in financing projects, and what support do you provide?
Thanks, Angela. I think the fundamental principle which I learned when I joined the DFI for the first time is that if a project cannot attract project development funding, it's most likely going to struggle to attract debt financing at the end. Any project that has the probability of attracting debt financing in the end or at financial close, if you look at it at concept, it should be able to attract project development funding at the very beginning. And the advantage of project development funding from a DFI, which is one of the roles that the DBSA plays, is that you have a bank looking at your studies throughout your development cycle, so that at the end or at financial close, there are no issues that are raised. In most cases, across our continent, as we all know, we have public entities coming and saying, I have prepared everything. Here is my file. Here is my PIM. Can you please give me $100 million? And then banks like Standard Bank, DBSA, etc., they go through it and they say, this is missing, this is not up to scratch, bank can't take this risk, etc., etc. Now, with DFIs, you have the opportunity to close those things up front and leave all questions about financial close right now while you're developing the project and not at the very end. So that is what the DBSA does with regards to this. My colleague here spoke, Alex just spoke about the risk of how long it takes to close a single infrastructure project, for example, and he spoke about 5.5 years. Now, that is a risk that a project developer faces upfront. You, in most cases, have the opportunity to partner with a DFI that has political mileage, that will be able to address some of the risks that actually frustrate private sector project developers during development phase. You also have the opportunity, for example, there's issues about regulatory approvals. In some countries you need some licenses, in some cases you need regulatory changes, etc. DFIs like the DBSA provide that type of support. But most importantly, as I highlighted earlier on, there is no, and it is an absolute fact, because I was a consultant and I had this myth or perception before I joined a DFI, there is no lack of project development funding for infrastructure projects on our continent. There is more money than the project can take. Thanks.
And now, George, we've heard from project development side of financing side. We've talked about exit mechanisms. Your view as a commercial bank, with the Basel III rules beginning to bite, what role do you see for the commercial banks moving forward?
Thanks, Angela. Before I touch on Basel III, I want to emphasize once again what my colleague from the DBSA said, which is that for the right project, there's enough money out there. And that applies both in respect of project development funding and also in terms of bank funding. Now, banks can get involved very early on in these transactions through advising clients in terms of the right structures, as we all know, and they ultimately then also provide the funding. So as long as you have the right developer and the right project you're pursuing, you'll be able to get it to market. I mean, we get inundated all the time by investors who are looking to put money into good projects. I suppose the challenge always is that the developer, wants to hold on to as much as possible until later on in the life of the project. I mean, if that's the case, then it boils down to, of course, making sure there's enough capital to take it to a certain stage. It involves having the track record to get a deal to a certain stage. And, we all know the likes of Aldwych and Global across the continent have had great success, and we're working, with them on numerous deals. And in certain instances, it gets tough when, you're sitting 4 years into a deal and you still haven't closed. I mean, it's a lot of pain for the developer, but at the same time, it's a lot of pain for the banks as well, who aren't getting paid. I mean, the lawyers get paid, but the banks sit there in anticipation of funding down the line. So we allocate resources, DFIs, commercial banks, in working on these projects, and we want them to close, and we can provide support to make that happen, but ultimately it rests on the shoulders of the developer to carry it through. So I just wanted to emphasize really what was said before. And then if you move to Basel III, and it sort of touches on to what my colleague from the JSE said, and yes, Basel III is biting to a certain extent. But what has happened, of course, is that increased regulations have meant that the cost of funds have largely increased for commercial banks. And it doesn't apply to institutional investors. It may not apply to other investors either who are looking to put debt into this deal. So it does get more difficult then for commercial banks to stay relevant in that space. However, there are models that will allow us to continue to be relevant. I mean, after all, there's a massive funding requirement, as we know. I mean, there's billions and billions of dollars required in South Africa and in the rest of Africa to fund the development of infrastructure. And we're just not doing enough as an investor community to actually make this happen. I mean, I don't think people really appreciate the massive, I suppose we do appreciate it, but I don't know if there's enough being done to mobilize enough capital to actually make these deals ultimately come to market. So commercial banks have to stay relevant, and yes, costs are going to make it trickier for us to stay relevant maybe for the long term. So what Basel III means is that long-term financing becomes more expensive, becomes more prohibitive for commercial banks. So we have to become innovative, and we have to work ultimately with the likes of the DFIs to put in place risk-sharing structures, and we've done that with the DBSA, we've done that with IFC, we've done that with AFDB, and we'll continue to do so, and we're very glad that they're obviously crowding us into these deals and making us relevant. Together with those partnerships, we're going to be able to raise sufficient capital to make these deals happen. Commercial banks have got liquidity, so it's about how you use it. How do we use it then? Yes, it's about maybe looking at banks providing construction finance initially, and to the extent that they're able to then provide long-term financing, they can do so. Problem is you can't refinance a commercial bank loan into, say, a DFI structure thereafter, because DFIs won't refinance commercial bank debt, as we all know. So it's really about tapping into capital markets. And yes, we are looking at those types of solutions, project bonds, and some of them have been done. We've done one in South Africa. In fact, we listed a renewable energy bond, or at least we did a project bond for renewable energy bond not too long ago. But at the moment, there's enough capital in South Africa to be able to offer financing to long-term projects. When, I suppose, we become too expensive and we're not the sort of obvious choice, then by all means other options will be pursued. And people have been thinking about project bonds for a long time, for capital markets to come and lend. And why hasn't it happened? It's because ultimately, the cost isn't better than what commercial banks can offer. It's because there's listing requirements, and certain clients don't want to do that. They don't want to sort of have the pain of having to have additional reporting requirements and so forth. So yes, it's something that ultimately people have to tap into and do if they do want capital, through those means. But the bigger problem for me is the rest of Africa. Is where are we going to get money for projects in Africa? And yes, you can sort of always offer dollar money on a cross-border basis, but it's becoming challenging. We're seeing that right now, where many countries are suffering to meet the dollar obligations because we've seen what's happened to commodities. We've seen what's happened to currencies as a result. So it's really about trying to find structures, maybe hybrid structures, where you can lend a portion in local currency, tap into local markets as well, look at the institutional investors in those markets, the pension funds, to offer, say, 8 to 10 year money, and then on a cross-border offer a bit of a longer term. But the depth of the capital markets in the rest of Africa is just not there at the moment. There isn't enough appetite, there isn't enough, I suppose, tenors available to make it feasible in terms of the tariff for the end user. So we've got to keep those challenges in mind, but it doesn't mean that we shouldn't be looking to help those markets develop. So yes, in South Africa, there's most certainly a lot of liquidity that's slushing around, that's keen to come and co-lend, and I think at some point that money is going to help free up capital for commercial banks, and hopefully we can convince the project bond investors that certain of those deals have been de-risked, and therefore the pricing is going to be cheaper once you're in operations. And that most certainly should be what people should aim to do when they look to refinance into capital markets. But the bigger challenge is what happens in the rest of Africa and how you actually use the local capital markets to do that. And that's where we desperately need the DFI as partners to offer credit guarantees, to offer enhancements, which is the case. I mean, that is most certainly happening. In certain countries, we're seeing IFC offering B-loan structures, which, is helping on a cross-border basis. But, we need to look at solutions for local markets, and that's where the real challenge is. So there's a space for everybody, and I think we've got to work together as a collective to address the infrastructure need. Thanks, Angela.
Thank you, panelists. I think we now open the discussion to the floor. Who will ask the first question? The first person gets a sweet from me. No takers? I'll up that chocolate. Guys, I guess you've done a very good job. Oh, okay, spoke too soon.
Thanks. My apologies, it's a lot more of a follow-up rather than a question. Mr. Munama mentioned the 4 funds that are available from the DBSA. I think you only went as far as 3. I'm sorry if I missed the 4th one, but I remember you went through the 100 million euros, and there was 10 million for that is the SADC Secretariat, and you also mentioned the 200 million for the infrastructure projects for RSA. What's the 4th one?
Thank you. Yes, it's 4. It's 100 million euros from the EU, which is the IPSA fund. We have the SADC fund, which is $10 million. Thirdly, you have the DBSA, which provides 200 million per annum. And then lastly, there is also a fund with AFD from France, which is about $12 million as well. Thanks.
I think we have no more questions. Either you did a very good job explaining or it was a very boring topic. Yes.
I want to challenge the proposition that we have enough project preparation facilities. You know, there have been studies, as noted before, that project preparation can go up to 12% of total cost. Plus, the usual structure of the available project preparation facilities is that they are fragmented. And there's not an integrated amount that goes for all the complex processes that you actually need to do from beginning to end. So, you know, I'm just curious as to, other people's view on the project development funding gap. And it eludes me, but I think in Africa, an estimate was given by the World Bank or the OECD as something like $1 trillion. I mean, it was a huge number that came up, where you guys see the value of DFI project preparation facilities, because many people think they're too hard to get to, too difficult, and not an answer. Thank you.
So who's going to take that? Okay, Alex first, and then I think Elliot will have something to say as well.
Yeah, thanks. I think there have been a lot of studies done of project preparation facilities, and that in itself, I think, is an interesting use of consulting and donor time. I think project preparation facilities shouldn't become, or development finance shouldn't become, or pre-financial close development finance shouldn't become a separate asset class, I think, as somebody talked about earlier on. And even the activity of project preparation facilities, I think the expression itself has such a wide variety of meanings, you know, from grant funding, pure grant funding, through to, you know, really quite commercial private equity style early stage capital that's being provided by governments across the spectrum of the development cycle. So I think in terms of, is there enough? Is it coordinated enough? I think from the earlier panel, it struck me that to get that very early funding for projects, you need a variety of funding sources, and some of it will be grant funding. I think for the kind of return, say, a pure developer without a balance sheet is looking for, like Electra, from a development project, and they vary from sector to sector, from country to country. But to really keep that developer in business, there's got to be grant funding to subsidize the kind of level of return that they're going to need. And so most of our projects, they see a combination of different things. So maybe another way to look at it is, what instruments are required to finance the development of projects in these kind of first-of-a-kind early-stage infrastructure environment. So I think there's a need for grant funding. I think there's a need for kind of repayable grants, and I think DBSA has kind of moved into that space, which I think makes a lot of sense. And then there's a need for even for loans, you know, which is kind of more in terms of what we're doing. We're often investing in the form of convertible loans during the development period. So we're putting our money in, so we can get it back at financial close. If things go well, we still have an option to capture some of the upside by converting that investment instrument into equity and perhaps capturing a higher return at financial close, or even staying in with some of our investments. So I think you need, and then there's kind of a pure equity investment or sort of mezzanine instrument. And in terms of, are there enough facilities? When I look at my own sort of organization, when I talk about my own organization, Infraco is part of the private infrastructure development group, and I see kind of 8 different facilities all providing different things, and so I think that's just one of the organizations out there is providing a very wide variety, providing guarantees, we're providing senior debt, we're providing grant funding. So I think the answer, it's a long way of saying, I think there's a lot of variety out there, and then you look at what the IFC is providing, you look at what are some of the European government development financing institutions like FMO and the Dutch government providing just on their own, the whole variety of things they're providing. I think that the variety is there. I think there's plenty of development finance available. I think getting it available quickly, and I think one of the things, you know, if I was selling Infraco, I would say we have a board of 5 private sector individuals who take decisions very quickly, and they have a ready pot of capital. So you need short decision making. I'm sitting over there in the corner with the project developers we're working with in Zambia, and they're constantly, we need a quick decision. Can we move to the next phase? And in a larger institutional framework, I think that's a challenge. And where a lot of this development, early stage capital finance is coming, where it's getting blocked up is if it's a large institution with a heavy approval framework, then I think it starts to lose the benefit full stop. Because if it's taking 6 months to approve the next round, the next required tranche of funding, the institutions are holding up the development timetable. And maybe that sort of brings me on to a sort of like, people ask us quite often, and DFID, who are one of the largest shareholders in my company, quite often say, pretty much every year, they say, why can't you do more? Why can't you invest more this year? The funding is available, do more projects. What's going on, Alex? Wake up, do some more projects. And what's the answer? And luckily, I've now had to work out a good answer to them. And my answer is it's institutional capacity on the government side, and it's generally vested interests. I think somebody mentioned utilities may not want to have a private sector project in their patch. So it's vested interests, and that extends to corruption. So government side resourcing, vested interests, and corruption are what are slowing up the development timetable I see from our side. Because I maintain it's not us. We can take decisions quickly. We have enough capital. We're short of people. Getting the people do projects, not capital, is my other answer to DFID. You have to get the right people in to do these difficult jobs in first-of-a-kind projects in difficult countries. And I see developers flying every weekend for years. I've done it, and it's actually a really tough job. So I think having the variety of funding out there is important. Having the right people to administer that funding and manage it well is even more important. And then I think you've got to have some capacity, some support on the government side to make transactions happen. You can't do a transaction without a well-resourced, capable counterparty on the government side.
George, how about consolidating the project development funds that you're managing?
Sorry,
Elliot.
Elliot, you wanted. I can also respond. I'd also like to respond, if I may, before Elliot does. And I think it's important once again to emphasize the point that governments also need to do their work to get these projects to a feasible stage. Very often developers are trying to chase deals where they're trying to negotiate a bilateral arrangement with the government, which most certainly does make sense, and then you need to have the right partners to help it go through. But we've got to distinguish between funds that are needed to help governments to get projects to sort of a feasible stage to take them to market, and then of course monies that are needed by developers to prepare, I suppose, submissions for these bids and to ultimately take them through to financial close. So the capacity on the government side very often is a challenge, both financially and in terms of people. So as Alex said, if you've got the right people to be able to I suppose, drive these projects to bring them to a feasible stage, things will happen. If you look at the renewable energy process in South Africa, we had a lot of champions driving the process here, which defined a program that investors could let into. And you had many sort of even fairly inexperienced developers coming to these projects to actually make them bankable. And of course, there's lots of willing money out there who's saying, well, if you've got the right project, we'll come and partner you. So, once again, I think there is money for the right project. Elliot.
Thanks, George. I think my colleague Alex just answered some of the questions in terms of availability of products out there. From the DBSA perspective, we offer pure grant financing for project development. We also have repayable grant over the life of a project. We also have project development loans for some projects. We have interest rate subsidies for projects which are highly risky, for which commercial banks' interest rate may be high. We also have capital grants where the project cannot handle debt of a particular amount. Now, it will be interesting to know what other product a development financing institutions should offer to enable project development other than those which I have provided. And the second part of your question was the fact that project preparation facilities are not integrated. Yes, most of them, of course, they are set up for different purposes, and it's understandable. But there is a difference between a project preparation facility and a project preparation facility that is run by a DFI. And the difference is one, and that is the one run by a DFI develops a project with an intention to reach financial close. Our scorecard is the value of projects developed. It's not the amount of money you spent.
Nancy, that's good enough?
Yeah, that's great. I want to see the scorecard. That should be part of the standards to disseminate.
Okay. Yeah, one more question.
I have questions for Georges. I think you mentioned that there were some infrastructure debt issuances that were starting to attract pension investors, right? And could you just mention a few landmark bond issuances in South Africa where you saw appetite from domestic or foreign pension or insurance investors?
I wouldn't say that there's a few. There most certainly is interest for institutional investors to lend to projects as opposed to project bond structures. They've lent directly to projects, and we've seen Sanlam, Future Growth. A lot of these institutional investors have actually come to market to co-finance projects with commercial banks. We were involved in a wind project financing in Kenya where we had the Danish pension fund, funnily enough, that was actually interested to lend to this wind farm in Kenya. Of course, it was with some credit enhancement, but it shows you that there is appetite. The question is whether it actually makes sense and whether it's cost efficient relative to what's actually available. And in SA, as I mentioned, there isn't that much of a difference between where institutional investors are pricing themselves currently and potentially then bond solutions relative to where commercial banks are pricing currently.
Thank you. I think that wraps it up. You've been a fantastic panel. Thank you, and a great audience. Thank you once again.
Doing business in Africa. You can't afford to be without Africa Investor.